If you're selling into California, your sales tax obligation is more complicated than you think. And here's the thing, California's economic nexus rules are actually among the more straightforward parts of compliance in the state. The complexity kicks in once you're registered and trying to collect and file correctly, because the rate structure in California is genuinely layered in a way that catches a lot of sellers off guard. We work with sellers navigating California compliance regularly, and today we're going to break down all of the details so the picture is more clear than it probably feels right now. Before getting into the complexity, let's cover the threshold, because relative to everything else in California, this part is clean. California's economic nexus threshold is $500,000 in gross sales into the state. No transaction count. The measurement period is the previous or current calendar year, and gross sales means all sales, wholesale and retail alike. Marketplace sales through platforms like Amazon are also included in that number. One thing worth noting, California does not offer a grace period. The moment a seller crosses $500,000 in California sales, Nexus is established that day. There's no waiting until the following quarter of the following year. Also worth flagging, economic nexus is just one way to establish Nexus, and this applies across all states. Physical presence alone is enough. Employees in a state, a warehouse, inventory stored at a fulfillment center, any of those create Nexus independently without needing to hit an economic nexus threshold. So for sellers with any kind of physical footprint in a state, the economic nexus question may already be settled before the dollar threshold even comes into play. Now for the hard part, because here's where California earns its reputation. California has a statewide sales tax of 7.25%. As of the date of the recording of this video, this is the highest state level rate in the country. But understanding what that 7.25% actually consists of matters, because the number can look different depending on how a return is broken out. On that 7.25%, 6% goes to the state. The remaining 1.25% is allocated to local jurisdictions and local transportation funds. So while 7.25% is the number sellers work with as the state-based rate, it already has a local component baked into it. And then on top of that 7.25%, counties and cities can layer additional rates within their own jurisdictions. These are called district taxes. So in a place like Los Angeles, a seller is looking at the 7.25% state-based rate plus a county tax to Los Angeles County, plus a tax to the city of Los Angeles. That stacks up to a total rate that is meaningfully higher than the 7.25%. This pattern repeats across many cities and counties throughout California. The total rate a buyer pays depends entirely on where the goods are being delivered. California has a tremendous amount of resources on the California Department of Tax and Fee Administration, or CDTFA, website that explain this in more detail. For sellers who want to go deeper on the rate structure and how allocations work, it's genuinely worth exploring. The layered rate structure isn't just a collection issue, it directly affects how the return is prepared. When filing with the CDTFA, sellers are generally required to allocate their sales among local jurisdictions. The state wants to know not just the total tax collected, but where sales were made, so the right local jurisdiction receives the right portion of the tax. For out-of-state sellers, this allocation process has its own specific rules, and how it applies can depend on several factors around where the sale originates and where the goods are delivered. This is one of the reasons California returns are considered among the more involved filings in the country. Similar to what we covered in the breakdown for the state of Florida video, this is one where having someone handle the filing who does this regularly is genuinely valuable. The mechanics are manageable once they're understood, but there are enough moving parts that errors can happen quietly if the return isn't put together carefully. And while California can be tricky, they are not alone, because New York's rules for their thresholds are going to catch you off guard if you're not aware. And for more on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.